Good day, everybody. My name is Stewart. I am the chairman of XXIX, which is a brand new company. It'll be formed actually today. We have our AGM, and it'll be born out of the result of a merger of two companies. One is called QC Copper and Gold, which is a publicly traded company on the Toronto Venture Exchange, and the other is a company called Cuprum, which is a private company. Between those two assets, they own two out of the three largest copper assets in Eastern Canada, and we're bringing them under one roof. And where we will together, where that company will be called, as I said, XXIX, which stands for 29, which is the atomic number for copper. XXIX will be our ticker symbol, and that'll all occur in the next day or so. As I said, the AGMs today get shareholder approval, and we're a brand new company. We copper focused, Canada focused, and we have two wonderful assets, which I'm going to walk you through the investment thesis and why I think the value, there's deep value in the company. There's huge potential in these two assets, and I'm going to run you through it. So let me get started. Before I talk about XXIX, I think it's absolutely critical that we talk about people. People in this industry is the absolute most important thing when you're considering any investment. And I think that me and my group have a track record of success. As I noted, we are a part of the OR Group, or XXIX is one of 7 publicly traded companies under our umbrella. We're all operated here out of Toronto, Ontario, Canada. We're almost exclusively focused in Canada in terms of asset acquisition, although we do have a diverse base of commodities that we have exposure to. You can see we have baseload energy, which is in uranium. We have metal energy, which is in copper. American Eagle Gold has been a tremendous success for us. That's got a very large copper gold porphyry in British Columbia. We've taken that company from $1 million to nearly $150 million market cap in a period of 2 years. We've attracted capital, all sorts of capital from the retail, obviously institutions and strategics. We've raised north of $200 million in equity and done an additional $200 million in joint ventures with major mining companies like Teck and Newmont. South 32 just invested $30 million with us 2 weeks ago, and many, many others. And also, I'll point out, Awali has been a tremendous success. That's a wonderfully gold asset in West Africa, our sole company outside of Canada. And then, of course, last but certainly not least is XXIX, which I'm going to tell you about today. But again, I implore you to go to the OR Group, learn more about us. We're an established group. We're owners. I'm the chairman of all of these companies here, the founder and one of the largest shareholders in each. We take a long-term view on assets. We are opportunistic, and when we acquire things, we think now is a wonderful time to be acquiring assets, good quality assets, of course, which we have the capability of assessing and acquiring. And that's exactly what XXIX is doing to form its new venture, if you will, and going to have 2 wonderful assets. But before I go again into XXIX and its assets, I want to lay out its investment thesis, and I'm going to do so by juxtaposing us next to Foran Mining. And for those of you who do not know Foran Mining, please look them up. Their symbol is FOM on the Toronto Stock Exchange, and they've been a wild success over the past 4 or 5 years. However, if you look back at them, if you look back at about 5 years ago and at the end of 2019, they were just like QC Copper or XXIX was. And I'm gonna say, go out on a limb and say nobody cared about it. It wasn't that they didn't have a good asset. It's just that the market didn't recognize the value. And that's my argument, that the market does not yet recognize the value that XXIX has. But look, Foran was a $20 million market cap. They had a 14-cent share price. Yet what did they have? They had a really nice resource. You can see their MRE was published in early 2019. It's a fairly good metal endowment. But you'll note that both assets within XXIX have more copper endowment than Foran did. But nonetheless, Foran went along, and then they moved forward and they published a pre-feasibility study, which to me is a milestone. And those are milestones that I'm going to demonstrate that XXIX is going to is going to publish on its Quebec asset and it's an Ontario asset. So that's an important part of our story and value creation is the publication of the pre-feasibility, because that is where the real detailed engineering is done. And that's where the project, the rubber meets the road, as they say. That's where real projects get defined, and you can really ascertain, is this going to be a mine? So that's one thing Foran did successfully. And then after that, you'll see they they skyrocketed up at the end of 2020. Why? It wasn't because of a drill hole. They didn't discover Voisey's Bay. Nothing really material happened other than they got access to capital. They were very successful in attracting $100 million investment from a gentleman by the name of Prem Watsa. And Prem is known as the Warren Buffett of Canada. He makes one or two mining investments every other year, so on and so forth. He's very choosy, but he selected this project because he saw a deep value. And then from there, the company really is at a linear upward approach, going from, again, in 2019 to a $20 million to today, a $2 billion valuation, all without no major discoveries. They just started off with a wonderful resource. And that's exactly where we are. So the argument that I'm making, the investment proposition and the value proposition, is that XXIX and its two assets, Opemiska, as you see there, and Thierry, which we're acquiring today, it'll close today, is that those two assets stand neck and neck with what Foran's asset is. Now, that's a bold statement, as Foran is currently worth $2 billion, but that's the sort of potential that I see, and I see that we have that potential times two. Because each of our assets, the Opemiska and Thierry, have a bigger starting point than McIlvenna Bay that Foran had many years ago. Now, obviously, Foran has developed it and de-risked it and published a feasibility and allocated capital intelligently. So hats off to them, done a wonderful job in creating value. But me and my group there's nothing that they don't have in terms of capability, and there's nothing that our assets don't have that McIlvenna Bay does not have. In fact, in certain instances, I'll argue we are better situated, certainly in terms of infrastructure. Again, something I'll show you that I would suggest that both Thierry and Opemiska have unparalleled access to infrastructure. Both projects are brownfields environments, which has all sorts of benefits in terms of timeframes, permitting, social license. The communities of which we operate in are very familiar with mining, which makes things go much smoother, all else equal. And of course, because both those assets had large-scale operations, we have the benefit of the legacy infrastructure. The Opemiska in Quebec is in the heart of Chibougamau, has rail, road, power, access to grid power, clean hydroelectric power, and the Thierry the same. So they're wonderful, wonderful assets. We are reinterpreting both these assets into open pits as well as underground scenarios, but you can see our grades, our size of deposits. Each of our assets have 2 billion plus copper equivalent resources, and we believe they're both going to get bigger, and then we're going to move them forward towards the de-risking. Now, let's drill down to the assets themselves and our path to pre-feasibility. Again, that is such an important milestone, is developing them and de-risking them. But you can see we're operating two of the best jurisdictions in Canada. I would argue Quebec has a slight lead over Ontario. That's where QC Copper, or now XXIX asset, is the Opemiska. It is in the heart of Chibougamau, which was operated, where Glencore had its major mine, which we own. It's called the Opemiska. Operated there for 40 years, produced where most of the copper and gold out of Eastern Canada through the 20th century, and has since been shut down. As I said, we have acquired that asset 5 years ago and reinterpreted it into a large-scale open pit deposit from what used to be an underground. And then Thierry. The Thierry is also, it's in Ontario. It's, again, access to infrastructure is excellent. It's in a very well understood mining jurisdiction called Pickle Lake, which is right beside Red Lake. It's in the same rocks as Red Lake. It's got mines operated by Newmont, and Barrick is next door to us, so it's a very established jurisdiction. And when this deal closes, again, it's a fait accompli. The shareholder meeting is today. The combined company, XXIX, will own 4.8 billion pounds of copper equivalent and growing. It puts us amongst the largest copper owners and developers in Eastern Canada. So this acquisition gives us scale. It's the right time to be acquiring assets, particularly complementary assets that are in the right stage of development. We understand the geology. Now is the time to move them forward towards the de-risking. And I'll note that both assets are complementary in the sense that they both sent their concentrate to Glencore's Horn Smelter in Quebec. So, and we anticipate that will hold true as these assets get developed and ultimately built. So let's talk a little bit more, dig down into what our assets are. Now, the Opemiska is our Quebec asset, okay? So that's the one that QC Copper owns today, and QC Copper is acquiring the Ontario asset. You can see there, Cherry, and when that deal closes today, it'll be rebranded as XXIX. Opemiska is officially the highest grade open pit copper deposit in Canada. You can see there, this is copper alone. It's nearly 0.8% copper. If I were to include the gold and the silver payable, we'd be nearly a full percent copper equivalent and about 100 million ton resource. So it's big enough, which is obviously key. When you're talking about base metals, it's going to have a multi-decade mine life. The grade is exceptional, and its infrastructure is unparalleled. So it's a very sexy asset. More de-risking is required, but that's what we're going to do. And then you can see our Cherry asset. That's the asset that we're acquiring today. And it's not as high grade as Opemiska. You can see the grade's about 0.4, but nothing has as high grade as Opemiska. But you can see we stand up next to the peers. Look at Glencore and Newmont and Teck, all of the assets there. The grade of Cherry stands up. It's good enough grade. It's by the infrastructure, which allows us to get away with less grade. And I'm going to demonstrate to you that we believe that Cherry is going to get materially bigger. And that's where our focused drill program is going to be in 2025. Back to Opemiska, just wanted to show you the infrastructure here. Again, the Opemiska, just to reiterate, it was operated by Glencore for nearly 50 years. It was 4 high-grade underground mines. You can see them plotted there. We've taken 2 of those mines and 1 million meters that was drilled by Glencore, and we stripped those meters down. We validated, we rebuilt the model. We did about 100,000 meters of our own drilling from surface, which ultimately culminated in our mineral resource estimate that was published in January of this year, which is approximately 100 million tons at 1% copper equivalent. But again, you can see the rail runs right through the property. We've got road, we've got an airport, we've got a local labor force, we've got a very sophisticated and friendly First Nations regime, and also communities there that are very pro-mining. As I said, this mine was operated within this community for 50 years. So everybody's parents and uncles and so forth were very familiar with this mine. So it's a wonderful place to be. And broader than that, Quebec is one of the best jurisdictions in the world. This is what the model looks like. We're quoting here 100 million tons in the MRE. This is the model that we built. You can see everything in purple was what was mined out and by Glencore, and that was mined over a period of about 45 years. The average grade throughout that mine was 3% copper, and some years they were mining 10% copper out of this. The cutoff grade was 1.5%, so meaning anything that was less than 1.5% when the mine was operating was left. And so as you can see in the mineralized envelope, which we depict here in the golden shade, that is our resource, which we have defined, and it's a pit-constrained resource, which goes to about 450 meters of depth there. So this right here from surface, mineralization runs right from surface, hence why we can reinterpret this into an open pit. And the model here goes down to 1 kilometer. However, this 100 million ton resource is largely constrained to the first 450 meters. As I said, it's pit constrained. We do see room for growth here as we drill and further de-risk this and take this towards the pre-feasibility, but largely the mineralized envelope is well understood, and it's time now to move the Opemiska, our Quebec asset, through to the feasibility, pre-feasibility stage. We've spent the bulk of 2024 doing an internal scoping study, evaluating a proper mine plan. That is going to be expressed in the first half of 2025 in a PEA. Everybody's familiar with a PEA. It's an important milestone, although it's largely a desktop study. That's why we defer, or we insist that the pre-feasibility is really the report that defines this. That's where you get detailed engineering, geotechnical drilling, etc. And we have a costed, budgeted plan to go through and publish our pre-feasibility study. We believe that will be done by the end of 2026. Obviously, there's some margin for error in there, but this plan is is in place. We're working towards it, and it's going to cost us approximately $10 to $12 million to execute that. So it's clear we've got a nice plan, and we're moving forward with it. And simultaneously, we have another asset within the company, of course, XXIX. This is our Cherry asset, and we're acquiring this again. It's been announced, it's in the public domain, but it's officially closing today upon shareholder approval, which we have. And Cherry is the largest copper resource in Ontario, which is significant. So we have two very significant assets all in one company. You can see Cherry stacked up next to, again, the big deposits within Ontario. I see Glencore, Vale, KGMH, etc. Cherry stands alone in terms of its size. And again, its infrastructure, the rail, the road, the power is all in place. You can drive a regular car right to the site on Cherry. So that means we can put more steel, more drill into the and drills or meters into the ground at a cost-effective price. It also obviously impacts the operating and the capital costs when we do evaluate these assets in terms of pre-feasibility, and they do go forward to production. So it has all the benefits. But what I'm going to point out here is there's two main areas of interest, three really, but I'm going to focus on two. One is called the K2, the underground deposit, which I'm going to show you the model in a second, as well as the K1 open pit. So there's two main areas of mineralization. We do believe these connect, but I'm going to show you locally what we've modeled based off 250,000 meters done previous to us. So we've taken the data, we've recreated the exercise that we did at Opemiska, which I said before, we took 1 million meters and validated that, which is a hugely laborious and skill-intensive process. We did the same thing with Cherry, and this is what we see. This is their underground deposit. Again, this is the deposit here on the west. This is 25 million tons at 1.6% copper. Now, that is a robust underground deposit. Like Opemiska, it was mined back in the 70s. And you can see here in the red, this is what we have backed out. This is what was mined. But you can see there's a very large mineralized envelope. That's where we're going to focus on de-risking and developing and growing. You can see here, we believe this area here to the west is open. So there's opportunity to grow this high-grade deposit. And I'll say that the 1.6% copper is, and that's copper alone, and that's a very high-grade deposit, especially when you consider its access is incredible, and it's going to get larger. I'll note that this is a copper-nickel deposit. If I were to include the nickel, we would get over 2% in copper, although we have less certainty on the metallurgy on the nickel. So we're really just focused on the copper for now, but there's definitely upside on understanding that nickel. This is the K1 now moving forward. So I'm just going to juxtapose you again. I just showed you the K2 underground, which is 25 million tons at 1.6. Now I'm going to show you the K1, which is again 4 kilometers to the east. And this is the open pit deposit here. And this resource here has 55 million tons at nearly 0.4% copper. Copper alone, there's a nickel credit here, but we're focused on the copper. And this resource here is only drilled to 150 meters. Okay, I think that's a very, very important point, why we think this is going to get substantially bigger. And I'm going to go back to our Opemiska model here just to show you again. This is down to 450 meters. So the Cherry open pit deposit is really just scratched the surface. Now, you need a little bit more than there. Just because one deposit goes deep doesn't mean the other one does. However, we have tested it. So beyond this resource, these holes were drilled this year, and you can see they were drilled at strike laterally and at depth to see if this does go deeper than 150 meters, which is where this resource is constrained. And the great news is that it does. You can see these intersections here of nearly 200 meters at nearly 1% copper equivalent, over 200 meters at 0.75% copper equivalent, and some wonderful indications that this is wide open. The geology here that we found on this drill program is very consistent, so you can sort of step out and expect to hit it. So what we plan to do on 2025 is a fairly robust drill program on the Cherry project in Ontario. Local drilling, as I said, we're going to focus on expanding this high-grade zone to the west. But I think we're going to get an awful lot of joy and drill hole success with this K1 deposit, again, focused on at depth and laterally here. And with a little bit of luck, I think we have the opportunity to connect these two zones. We do believe that these zones are connected. The mineralogy is the same. They are on strike. There is geophysical anomalies which suggest they are. The question is, can we find it? We think we can. And does it add economic grade material? Well, only time can tell, but we're going to drill it out. We certainly think this is lower risk drilling. This is lower risk drilling, and this is blue sky in between here. And before I move on, there's a whole nother zone down in the what we call the J and the G zone down to the south of the property. We have less information, less data on it. However, it has a fairly sizable historic resource itself, another 50 million tons at 0.4. This is historic resource. Again, we don't know it as well, but what is clear is that this is a very mineralized property. There's lots of blue sky. It has been owned and operated by a company that was completely capital constrained and not focused on it. So it's really been sitting dormant for almost 30 years. And now, since we are acquiring it, we've de-risked it, we've understood the data. As I said, we've used the skills and that we learned through the Opemiska in terms of understanding historical data and understanding what the model is and where the opportunity is to grow. And once we're done in 2025, as I said, 2025 is going to be a robust drill program on Thierry because we think it's going to get bigger. It has the potential to get orders of magnitude bigger. And then once we're done that, and we think 2025 is probably a good rough estimate of how long it will take us to understand and test the limits of that deposit. And then we go right into the same de-risking regime and program that we've developed with the Opemiska. So again, pre-feasibility is the goal. We believe it's a 2-year time frame to do that, and anywhere from $10 to $12 million. It might cost a little bit more on Thierry because we're less. It's further behind in terms of development, but it's going to catch up quickly in 2025 as we drill it out. So again, we have a very clear plan. Both assets have distinct but clearly developed plans to move forward and de-risk. And as I look to conclude, I will bring up our corporate overview. I think it's critical for everybody to understand the details of the transaction and what the combined company looks like upon closing, again, which is occurring today. As of this morning, when we open, we'll still be called QC Copper and Gold. The ticker symbol will be QCCU on the Venture Exchange. But in the next 24 hours or so, after it all trickles through the system, the company will be known as XXIX with that same ticker symbol. We'll have an implied market cap of about $40 million and about $7.5 million in cash, plus about 11 million shares of baseload energy, which is one of our ore group companies, which is busy drilling away in the Athabasca region. So we'll be well financed, we'll be well capitalized, we're getting scale, and we'll be one of the largest owners of copper in Eastern Canada. Again, talking about people, as I said, I introduced myself. I am the chairman and the founder of this company. I founded the company alongside with Charles Baudry, who's been the business partner of mine and the key geologist and the visionary behind the Opemiska. Charles had the idea. He was the one that came up with the concept that this high-grade underground mine could be turned into an open pit, and he is correct. About a year and a half ago, when we knew we were going to move forward to the development side of things, we brought in Guy Lebel. Guy is a mining engineer. He is a corporate development type who has 30 years of experience with big successes like FNX Quadra, as well as Capstone Mining. And Guy runs the day-to-day on the company and is responsible for the engineering aspects that gets us through to the pre-feasibility. These are our forward-looking statements, which are ubiquitous in this industry. So I encourage you to do your due diligence, and corresponding with that, I am always available for any questions. This is my email and my phone number that goes right to my cell phone. And I make myself available to shareholders and happy to answer any further questions. But with that, Julian, I thank you for the opportunity to present to your audience, and for everybody on the call this afternoon and this morning, depending on where you are. Grateful for your attention, and I look forward to speaking to you if you have any questions. Thank you.
Well, thank you very much for the presentation, Stephen. That was very interesting. Obviously, the launch date is today. Foundation of the companies is very, very good timing for you to have, for us to have you on board. One question that has been asked, and I think it's a relevant one: will you have a flagship project between both, or exactly how are you going to split energy, time, money, and so on?
So both projects, it's a very good question. I get that question a lot. And I wouldn't say any one is our flagship. I would say if you want to talk flagship corresponding to valuation, which isn't necessarily an accurate way of looking at it, the Opemiska is and QC Copper is valued at 2/3 of the combined company, whereas the asset Ontario is valued at 1/3. So, I mean, you can draw implications there. However, I think they're both flagship projects. They're both sizable projects. They both have the potential, the real potential to go into production. We believe that, we have conviction. Both need to be de-risked, both need to be grown. As I indicated, they're at different stage of their life cycles, which I think is relevant for everybody familiar with the junior mining business. We all know the Lassonde curve. And I think as we enter into the study phase, it gets into what the market deems as boring. And I disagree. I think it's exciting to understand if the project is real, and that's where Opemiska is. So Opemiska is going into the study phase, moving towards the goal of pre-feasibility, whereas Cherry, the new asset, is really in growth mode. And I think that's interesting. Yep. And that counterbalances any perception of where we are in the Lassonde curve, because we're going to be putting out a lot of drill holes in 2025 from Cherry. And as I noted before, it's going to get larger. So we've got two assets. They both have a lot of similarities. I call them analogs. They're at staggered parts of their development phase. They're both advanced. And they both can be developed in parallel. We don't see any reason why they cannot. At a certain point in time, when you get a pre-feasibility study, then you can evaluate and see which asset competes for capital. However, we are funded to move both forward for the foreseeable future. Like any junior mining company, there's always the prospect of raising capital down the road. But for now, we don't have a gun to our head. We can move forward and both projects in parallel. I hope I answered your question there.
Absolutely, perfectly well. Another question, how did you came to merging those two companies together? Basically, you had them both in your portfolio as the OR group. Is it a strategy we can expect from more of your companies in the OR group? And what was the discussion that said, well, guys, rather than having them separate, obviously there's a synergy, both copper and so on, but can you tell us a little more about why now merging those two companies together?
Sure. So the background of QC Copper, which is the acquirer, is that it was founded back in 2019 with Charles, Alex, and myself. We did so by acquiring an option on the Opemiska, which is the asset in Quebec. We have since exercised the option. We own Opemiska 100% without any option payments, without any debt. And that has been the core focus of the company. As the chair and the founder of the OR Group, I am very active in evaluating assets all the time. We get a lot of deal flow. One of the opportunities that came across our plate maybe about 18 months ago was what became Cuprum. And ultimately, we acquired Cuprum in a private company. At the time, yep. I wanted to put it into QC Copper. However, the circumstances of QC Copper and the circumstances of how we acquired Cuprum just wouldn't allow for it. We effectively acquired Cuprum out of what I call a distressed situation. The vendor, or I should say, the company from which we acquired it from was in debt, and ultimately we acquired their debt they were not in compliance with, say, in default, and we forced the sale. So I bought the note, forced the sale, and to avoid any litigation or foreclosure procedures, we invited the vendor to become a shareholder in the company to ease the transition and have a friendly solution, which is always better in this industry. So it just didn't work out to put it into QC Copper at the time. In a perfect world, I would have put it in QC Copper back then. I should note at that time, when we did acquire it and put it into the public company, I did have QC Copper acquire a toehold position at 9.9%. So QC Copper has always owned 9.9%. That was sort of a head tip of my intentions. What the private company did over the course of the year until we get to this point was it de-risked Cuprum. It raised money arm's length from a series of very high net worth investors. We raised about $1.5 million. We drilled out. So that's where we understood. So we did two things. We validated that database. We had greater confidence in the resource, which is, again, a laborious process. And we drilled those holes, those 6 or 7 holes that I showed you on earlier slide that had over 200 meters and a number of instances of very wide copper intersections. So we got to know the asset. We said, yes, this belongs. We have confidence in the geology. We have confidence in the ability to grow it. We got our team familiarized with it, and we said now is the time to do it because we're moving in forward with Opemiska through the de-risking phase, and now we want to introduce some growth. And so, carpe diem, I suppose. There was no perfect time to do it, but now is the time. And shareholders, as I said, shareholder approval is in hand. We've had 99.1% shareholder approval on the deal, and our share price is behaved, accordingly. So, but still, I think there's huge value, which has not yet been recognized in the project. But anyways, I won't linger on, but that's why we decided to acquire the project now.
No, that makes absolute sense. Obviously, I think that currently the market being in the state that it is, it was a good time to obviously do such deal and so on, maximize liquidities, cash on hand and so on, and then be able to save obviously on overhead and a lot of costs that those companies usually share, and that shareholders really like to see the ratio of G&A quite often go down from these mergers and so on. So Stephen, thank you very much for being with us. Mr. Lynch just joined in. So Stephen, I invite everyone to keep on following the 29th company story, and hopefully see your development in our next IIF. Thank you.
Thanks again, everyone. Take care.